Another challenge involves inflation. Inflation is not simply about higher prices at the grocery store. It reflects the declining purchasing power of money over time. When inflation remains elevated, households must spend more to maintain the same standard of living. Savings lose value more quickly. Retirement planning becomes more difficult. Businesses face rising costs. Although inflation may appear under control compared to previous peaks, its long-term effects continue shaping financial decisions throughout the economy. The average American family has also experienced growing financial pressure. Housing costs remain elevated in many areas. Insurance expenses have increased. Healthcare costs continue rising. Credit card debt has reached significant levels. Even families with stable incomes often feel as though their money does not stretch as far as it once did. This creates an important psychological effect. Consumers become more cautious. Spending slows. Economic momentum weakens. What begins as a household budgeting challenge can eventually affect the broader economy. At the same time, many investors remain focused primarily on the stock market. Stock prices often dominate financial headlines because they provide a visible measure of economic confidence. However, stock markets do not always tell the entire story. Some of the most important signals come from areas that receive far less attention, particularly the bond market. Bond investors are often highly sensitive to long-term risks involving inflation, debt, and economic growth. Their actions can reveal concerns that are not yet reflected elsewhere. One reason these developments matter is because America occupies a unique position in the global financial system. The U.S. dollar remains the world's dominant reserve currency. Governments, corporations, and financial institutions around the world use dollars for trade, investment, and reserves. This position provides significant advantages. It allows the United States to borrow at lower costs and maintain extraordinary influence over global finance. However, no financial system remains unchanged forever. History demonstrates that even dominant currencies eventually face challenges. Around the world, some countries are actively seeking alternatives to dollar dependence. Central banks have increased gold purchases. Certain nations are experimenting with new payment systems. Others are pursuing greater diversification in their reserve holdings. None of these developments necessarily threaten the dollar's position in the near term. However, they illustrate a broader trend that many investors are monitoring closely. Small changes occurring gradually over many years can eventually reshape financial systems in meaningful ways. Technology represents another major force transforming the economy. Artificial intelligence, automation, and digital innovation are advancing at extraordinary speed. These technologies offer tremendous opportunities for productivity and economic growth, yet they also introduce uncertainty. Entire industries may evolve faster than expected. Job requirements may change dramatically. Businesses that fail to adapt could struggle to remain competitive. Economic transitions driven by technology often create both winners and losers, making future outcomes difficult to predict. One of the most important lessons from history is that economic shifts rarely announce themselves clearly. Most people expect major changes to arrive with obvious warning signs. In reality, transitions often occur gradually. Conditions seem normal while underlying trends quietly strengthen. Then a catalyst emerges that accelerates developments already underway. By the time the majority recognizes what is happening, the opportunity to prepare may have largely passed. This is why long-term investors spend so much time studying cycles rather than headlines. Daily news can be distracting. Markets react to countless short-term events that ultimately prove insignificant. Long-term trends, however, often shape financial outcomes for decades. Debt accumulation, demographic changes, technological transformation, and monetary policy decisions may seem boring compared to breaking news stories. Yet these forces often determine the direction of economies over extended periods. Demographics present another challenge that receives surprisingly little attention. Large numbers of Americans are approaching or entering retirement. This creates pressure on programs such as Social Security and Medicare while reducing the growth rate of the labor force. As populations age, governments face difficult choices regarding spending, taxation, and benefits. These demographic realities develop slowly but have profound long-term consequences. The labor market itself is undergoing significant change. Remote work, automation, artificial intelligence, and evolving business models are transforming employment opportunities. Many traditional career paths are becoming less predictable. New industries are emerging while others face disruption. Workers increasingly need adaptable skills rather than relying on a single profession throughout their entire careers. This transition may create opportunities for some individuals, while creating uncertainty for others. Financial markets are also adjusting to a world of higher interest rates. During the era of ultra-low rates, investors became accustomed to abundant liquidity and inexpensive borrowing. Asset prices benefited from these conditions. However, when rates rise, the financial environment changes. Borrowing becomes more expensive. Riskier investments face greater scrutiny. Valuations adjust. Markets that once seemed unstoppable can suddenly encounter resistance. Despite these challenges, it is important to recognize that economic change does not automatically mean economic collapse. America remains one of the most innovative economies in the world. Its businesses continue leading technological advancement. Its capital markets remain among the deepest and most liquid globally. Its workforce continues generating remarkable productivity. The issue is not whether America will disappear as an economic power. The issue is whether people understand how changing conditions may affect their financial future. Perhaps the greatest risk facing most Americans is not a specific economic event but a lack of preparation. Many households assume that future conditions will resemble the recent past. They expect markets to recover quickly, borrowing costs to remain manageable, and economic growth to continue indefinitely. While optimism is valuable, history teaches that economic environments can change significantly over time. Those who prepare for multiple scenarios often navigate uncertainty more effectively than those who assume a single outcome. The reality is that major shifts are already occurring. Debt levels are rising. Interest costs are increasing. Global financial relationships are evolving. Technological disruption is accelerating. Demographic pressures are growing. These trends may not dominate everyday conversations, but they are shaping the future nonetheless. The people who recognize these changes early have an opportunity to adapt. Those who ignore them may eventually find themselves reacting rather than preparing, and that is precisely why so many investors believe most Americans don't see what's coming next. The biggest changes are rarely obvious while they are happening. They develop gradually beneath the surface, hidden by the normal routines of everyday life. Yet when the effects finally become impossible to ignore, the world often looks very different from the one people assumed would continue forever. If there is one area of the financial system that deserves far more attention than it receives, it is the bond market. Most Americans rarely think about bonds. Financial news focuses heavily on stocks, cryptocurrencies, and technology companies because those stories generate excitement and attract attention. Yet many professional investors consider the bond market far more important than the stock market when it comes to understanding the future direction of the economy. The reason is simple. Bonds influence borrowing costs throughout the entire financial system. Mortgage rates, car loans, business financing, government debt costs, and consumer credit are all connected to what happens in the bond market. And right now, the bond market may be sending a warning that many people are ignoring. For years, investors became accustomed to an environment of extremely low interest rates. Following the financial crisis of 2008 and later the pandemic, central banks around the world lowered rates to support economic growth. Cheap money encouraged borrowing, spending, and investment. Home prices surged, stock markets climbed, businesses expanded, governments borrowed heavily. For a long time, it seemed as though low interest rates would remain a permanent feature of the economic landscape. But history shows that financial conditions never stay the same forever. As inflation began rising, central banks were forced to respond. Interest rates increased rapidly in an effort to stabilize prices and restore confidence in the value of money. While these actions helped address inflationary pressures, they also created new challenges. Higher interest rates affect every borrower in the economy. Families face larger mortgage payments. Businesses encounter more expensive financing costs. Governments spend more on interest payments. Economic growth often slows as a result. What makes the current situation particularly significant is the sheer amount of debt accumulated during the low-rate era. When money was inexpensive, borrowing appeared relatively risk-free. Governments expanded deficits. Corporations issued debt to finance growth. Consumers purchased homes and financed major expenses. These decisions made sense when rates were near historic lows. However, higher rates have changed the equation. Debt that once seemed manageable now carries much greater costs. The U.S. government provides one of the clearest examples of this challenge. Every year, Washington spends more money than it collects in revenue. The difference must be financed through borrowing. As national debt grows, so do interest obligations. When rates rise, the government must devote more resources to servicing existing debt. This creates a difficult cycle. More borrowing leads to more interest payments. More interest payments can contribute to larger deficits. Larger deficits require additional borrowing. Over time, investors begin paying closer attention to whether this cycle can continue indefinitely. Many people assume governments can simply print money whenever debt becomes a problem. While governments with sovereign currencies possess unique financial flexibility, excessive money creation often creates inflationary pressures. History provides numerous examples of countries that attempted to solve debt problems through monetary expansion only to encounter currency weakness and rising prices. The challenge is finding a balance between supporting economic growth and maintaining confidence in the financial system. Confidence plays an essential role in modern economies. Every financial system ultimately depends on trust. Investors trust that bonds will be repaid. Consumers trust that money will retain value. Businesses trust that financial markets will function efficiently. Governments trust that investors will continue purchasing their debt. When confidence remains strong, economies generally operate smoothly. When confidence begins eroding, even small concerns can create significant consequences. One reason some investors are paying close attention to the future is because confidence cannot be measured directly. It reveals itself through behavior. Investors demanding higher yields on government debt may be expressing concern about future inflation. Businesses delaying investments may be signaling uncertainty about economic conditions. Consumers reducing spending may indicate financial stress. These individual decisions often appear unrelated at first. Together, however, they can reveal broader shifts taking place beneath the surface. Another factor influencing the economic outlook is the housing market. Housing plays a central role in American wealth creation. For many families, a home represents their largest financial asset. Rising home values create confidence and encourage spending. Falling home values often have the opposite effect. Higher mortgage rates have dramatically increased the cost of purchasing a home, reducing affordability for many buyers. This has slowed activity across portions of the housing market and created challenges for industries connected to real estate. The impact extends beyond housing itself. Construction companies lenders, furniture manufacturers, appliance makers, and countless service providers depend on a healthy housing market. When activity slows, the effects spread throughout the economy. This interconnectedness explains why housing often receives significant attention from economists monitoring recession risks. At the same time, corporate America faces a changing environment. Many businesses enjoyed years of easy financing and abundant liquidity. Today, they must operate under different conditions. Companies carrying significant debt burdens may encounter rising interest expenses. Profit margins can come under pressure. Investment decisions become more difficult. While large corporations often possess resources to adapt, smaller businesses may face greater challenges. Small businesses deserve particular attention because they remain a critical source of employment and innovation. Unlike major corporations, small firms often lack extensive financial reserves. They depend heavily on access to affordable credit and consistent consumer demand. When financing becomes more expensive and spending slows, these businesses frequently feel the effects first. Their struggles can provide early signals regarding broader economic trends. The labor market remains one of the brightest areas of the economy, but even here there are reasons for caution. Employment figures often appear strong until economic slowdowns are already underway. Businesses typically avoid layoffs whenever possible because recruiting and training workers is expensive. As a result, labor markets tend to lag behind other economic indicators. By the time unemployment rises significantly, economic weakness may already be spreading. This creates an important psychological challenge. Many people judge economic conditions based primarily on employment. If jobs remain plentiful, concerns about recession may seem exaggerated. However, economic turning points rarely announce themselves clearly. They develop gradually through changing spending patterns, slowing investment, and tightening financial conditions. Employment often reflects these developments only after they have been underway for some time. Technology adds another layer of uncertainty to the outlook. Artificial intelligence is advancing faster than many experts expected. Businesses across numerous industries are exploring ways to automate tasks, improve efficiency, and reduce costs. These innovations may increase productivity and support long-term growth. However, they may also disrupt labor markets and alter traditional business models. The full economic impact remains difficult to predict. Throughout history, major technological shifts have created both opportunities and challenges. New industries emerge while existing industries adapt or decline. Workers develop new skills. Companies transform operations. Economic growth often benefits in the long run, but periods of transition can create instability. The current wave of technological innovation may prove no different. Global developments further complicate the picture. The United States does not operate in isolation. Economic conditions in Europe, Asia, and other regions influence trade, investment, and financial markets. Geopolitical tensions, supply chain disruptions, and shifting alliances all affect economic outcomes. Events occurring thousands of miles away can influence inflation, energy prices, and investor confidence within the United States. One trend attracting particular attention is the growing interest among some countries in reducing dependence on the U.S. dollar. The dollar remains the dominant reserve currency and continues to play a central role in global trade. However, some nations are increasing gold reserves, pursuing alternative payment systems, and exploring greater diversification. These developments are gradual and unlikely to replace the dollar overnight. Nevertheless, they illustrate how global financial systems evolve over time. The most important lesson may be that economic risks rarely emerge from a single source. Recessions and financial disruptions often result from multiple pressures developing simultaneously. Debt burdens increase, borrowing costs rise, consumer spending slows, confidence weakens, financial conditions tighten. Individually, Each challenge may appear manageable. Together, they can create powerful headwinds. This is why some investors believe the next major economic shift may surprise most Americans. People naturally focus on immediate concerns while overlooking long-term trends. They assume tomorrow will resemble yesterday. Yet history repeatedly demonstrates that significant changes often occur gradually and then suddenly. Warning signs appear long before the majority recognizes their importance. Today, many of those warning signs are visible. Rising debt, higher interest rates, slowing affordability, growing fiscal pressures, technological disruption, global uncertainty. None of these developments guarantee a crisis, but together they suggest that the future may look very different from the recent past. The question is not whether change is coming. Change is always coming. The question is whether individuals, businesses, and policymakers will recognize the signals early enough to adapt, because when economic cycles turn, those who prepared in advance often navigate the transition far more successfully than those who assumed the good times would last forever. So what happens next? That is the question millions of Americans are asking. People see rising prices, growing government debt, expensive housing, and constant discussions about recession risks. Yet at the same time, the stock market continues attracting investors, businesses continue hiring workers, and the economy appears more resilient than many experts expected. This contradiction creates confusion. How can warning signs exist alongside economic strength? The answer is that major economic transitions rarely happen all at once. They unfold in stages. The conditions being created today often determine the opportunities and challenges of tomorrow. One of the biggest mistakes people make during periods of economic uncertainty is assuming that a crisis will look exactly like previous crises. Many Americans still compare everything to 2008 because that financial collapse left a lasting impression. But history shows that every major downturn has different causes. The Great Depression was different from the inflation crisis of the 1970s. The dot-com crash was different from the housing collapse. The next recession, if one occurs, will likely have its own unique characteristics. Looking for an exact repeat of the past may cause people to miss the warning signs developing right in front of them. The next economic slowdown could begin with something as simple as reduced consumer spending. For decades, consumer spending has been the engine of the American economy. When consumers feel confident, businesses thrive. Companies hire more workers. Investment increases. Economic growth accelerates. But when consumers become cautious, the opposite occurs. Spending slows. Revenue declines. Businesses become defensive. Hiring weakens. Growth begins to fade. Because consumers account for such a large share of economic activity, even small changes in behavior can create significant ripple effects. Many households are already feeling financial pressure. Credit card balances remain high. Auto loans are expensive. Mortgage rates are far above the levels many Americans became accustomed to during the previous decade. Insurance costs continue rising. Everyday expenses consume a larger portion of family budgets. While these pressures may not trigger an immediate crisis, they gradually reduce financial flexibility. Families become more selective about spending decisions. Vacations get postponed. Major purchases are delayed. Discretionary spending declines. These subtle shifts often appear long before broader economic weakness becomes obvious. Businesses face their own challenges. Rising labor costs, borrowing expenses, and operational costs are squeezing profit margins. Some companies can pass these costs to consumers through higher prices. Others cannot. As financial pressures increase, management teams begin searching for ways to reduce expenses. Hiring slows. Expansion plans are delayed. Investments are postponed. These decisions make sense individually, but collectively they can contribute to slower economic growth. At the same time, investors remain focused on financial markets. Many believe central banks will eventually lower interest rates and restore conditions similar to those that existed before inflation surged. But the future may not be that simple. The world has changed, debt levels are higher, geopolitical tensions are more significant, supply chains are more complex, demographic trends are creating new pressures. Policymakers must navigate challenges that did not exist in previous cycles. This is one reason some analysts believe the next decade could look very different from the last decade. During much of the previous era, low inflation and low interest rates supported asset prices. Stocks, bonds, and real estate benefited from abundant liquidity. Investors became accustomed to a financial environment where borrowing was inexpensive and money flowed easily throughout the economy. If higher rates become the new normal, investment strategies that worked in the past may not perform the same way in the future. Another important factor is the growing gap between perception and reality. Many Americans judge economic conditions based on headlines or stock market performance. However, economic reality is often more complex. A rising stock market does not automatically mean every family is thriving. Strong employment figures do not guarantee long-term stability. Economic strength can exist alongside structural weaknesses. In fact, some of the most important imbalances develop during periods of apparent prosperity. History provides many examples. Before major downturns, confidence is often high. Investors believe risks are manageable. Consumers continue spending. Businesses remain optimistic. Warning signs exist, but they are frequently dismissed because immediate conditions appear stable. Then a catalyst emerges. It may be a financial shock, policy mistake, geopolitical event, or unexpected market reaction. Whatever the trigger, underlying weaknesses suddenly become impossible to ignore. This is where preparation becomes more important than prediction. No one can forecast the exact timing of future events. Even the world's most successful investors are frequently wrong about timing. What matters is understanding the risks and building resilience. Financial resilience allows individuals to adapt regardless of what happens next. For many households, resilience begins with managing debt. High-interest debt can become a serious burden during economic slowdowns. Reducing unnecessary liabilities improves financial flexibility and reduces vulnerability to unexpected events. Building emergency savings serves a similar purpose. Cash reserves provide breathing room during periods of uncertainty and reduce dependence on borrowing when conditions become difficult. Investing also requires a long-term perspective. Market volatility often increases during economic transitions. Prices move rapidly. Headlines become emotional. Fear and greed dominate decision-making. Investors who react impulsively frequently make costly mistakes. Long-term success often depends on maintaining discipline when uncertainty is highest. History shows that markets eventually recover from recessions, financial crises, and economic shocks. The challenge is remaining patient enough to benefit from that recovery. Diversification becomes increasingly important during uncertain periods. Concentrating wealth in a single asset, industry, or investment theme can create unnecessary risk. Different economic environments favor different assets. Diversification does not eliminate risk, but it can reduce exposure to any single outcome. This principle has remained true throughout financial history. One area receiving increasing attention is hard assets. Gold, commodities, infrastructure, and other tangible assets often attract interest during periods of inflation and economic uncertainty. Investors view these assets as potential stores of value when confidence in financial assets weakens. While no investment is perfect, the growing interest in diversification reflects broader concerns about the future economic environment. The future of the dollar is another topic generating debate. The U.S. dollar remains the most important currency in the world. It dominates global trade, financial transactions, and reserve holdings. This position provides enormous advantages to the United States. However, maintaining reserve currency status requires confidence. Investors, governments, and institutions must believe that the dollar will remain stable and reliable over time. Some countries are exploring alternatives, increasing gold reserves, and developing independent payment systems. These trends do not mean the dollar is about to lose its position. The dollar remains deeply entrenched in the global financial system. However, they do suggest that the world is gradually becoming more multipolar. Financial influence may become more distributed over time, creating a different global landscape than the one that existed for much of the past century. Technology may ultimately play a decisive role in shaping the future. Artificial intelligence has the potential to transform productivity, healthcare, education, manufacturing, and countless other industries. Technological innovation could offset many economic challenges by increasing efficiency and creating new opportunities. However, transitions of this magnitude often create disruption. Before benefits become fully apparent, workers, businesses, and governments will need to adapt. Demographics also remain a powerful force. Aging populations create challenges for retirement systems, healthcare programs, and labor markets. These pressures develop slowly but have enormous long-term implications. Governments may face difficult choices regarding spending priorities, taxes, and benefits. Economic growth may increasingly depend on productivity improvements rather than labor force expansion. Perhaps the most important lesson is that economic cycles are natural. Booms and busts have occurred throughout history. Periods of prosperity are followed by periods of adjustment. The goal is not to fear change, but to understand it. Those who recognize long-term trends often position themselves more effectively than those who focus exclusively on short-term headlines. The reality is that America still possesses extraordinary strengths. It remains a global leader in innovation, entrepreneurship, technology, finance, and higher education. Its businesses continue creating value. Its markets continue attracting capital from around the world. Its economy remains among the most dynamic on Earth. The challenges are real, but so are the opportunities.